Today, is the RBA doomed? Hello again, it's Martin North from Digital Finance Analytics, web latest post covering finance and problem news with a distinctively Australian flavour. Well, given the current dynamics, we've been watching the RBA closely, hence the recent shows on IOTP with John Adams, where we've been discussing the contention between lifting interest rates, an economic slowdown, and potential liquidity issues. And of course, home prices may slide, which could create financial stability issues. Indeed, Christopher Joy is talking about possibly a 30% fall. Now, the 2-year Australian yield curve is at around 3.4%, and that's a good indicator of where the cash rate will be headed, suggesting higher rates for mortgage holders and businesses ahead. Indeed, mortgages could be somewhere between 5 and 6%. But today, I want to look at some of the other issues which are there below the waterline for the RBA. Following last Tuesday's post-meeting statement, when the RBA lifted the cash rate by 50 basis points, they also increased the rate paid on the exchange settlement deposits by 50 basis points to 75 basis points. Now, those accounts at the RBA are used for payment settlement by the banks, but the balances held there have been rising recently. These funds are held in accounts at the Reserve Bank by banks, as well as a small number of other financial institutions, and are used by account holders to meet their payment obligations with each other and with the Reserve Bank. Under arrangements introduced in November 2013, some ADIs maintain a quantity of ES funds in their account as a buffer against intraday payments and payments that they may need to settle after the time that the interbank cash market has officially closed. The size of these buffers is agreed in advance with the Reserve Bank. And to facilitate these liquidity buffers, ESA holders have the option to directly source ESA balances through transactions, open-ended repurchase agreements or open repos between ESA holders and the Reserve Bank. In the several years up until early 2020, the supply of surplus ES funds beyond those agreed buffer amounts had typically been between $2 billion and $3 billion. But the policy measures announced by the Reserve Bank since March 2020 has led to considerable changes in the cash market. The Reserve Bank's transactions with financial institutions alter the supply of ES funds, and so the Reserve Bank's bond purchases and the Term Funding Facility program have significantly increased balances held in the ES accounts. I want to highlight the point that the banks have had a big win here, given the rising of the interest rates paid on funds in the settlement accounts. Just remember this: at the height of the crisis, the RBA threw a massive amount of cheap money to the banks by way of that Term Funding Facility, or TFF as it's known. In an article on the TFF in September 2021, the RBA discussed the TFF in some detail, but in short, in 2 tranches, the RBA gave the banks access to cheap funds. In March 2020, the Reserve Bank Board announced the Term Funding Facility as part of a comprehensive policy package to support the Australian economy in response to the COVID-19 pandemic. The facility has provided low-cost 3-year funding to banks operating in Australia. As for all central bank funding, funds are lent against high-quality collateral, and the TFF had 3 overall aims: to support the banking sector to continue to extend credit to households and businesses at a time when wholesale funding markets had been significantly disrupted, lowering funding costs for banks and, in turn, lowering borrowing rates for their businesses and household customers, and to encourage banks to increase their lending to businesses, particularly small and medium-sized enterprises. The TFF initially gave banks access to 3-year funding at a cost of 0.25%, with an initial allowance equivalent to 3% of each bank's total credit outstandings, and banks could access their initial allowance until the 30th of December 2020. There was also an additional allowance, which was available until the 31st of March 2021 to any bank that managed to expand its business credit, particularly to SMEs. For every extra dollar lent relative to the pre-pandemic baseline to large businesses, a bank could increase $1 additional of funding from the Reserve Bank And for every extra dollar lent to SMEs, it has access to an additional $5 funding. The Reserve Bank Board made a number of adjustments to the TFF in response to changes in economic and financial conditions. In September 2020, the TFF was expanded with a new supplementary allowance for each bank, equivalent to 2% of its credit outstanding, available to be drawn between the 1st of October 2020 and the 30th of June 2021. Also, the period of drawdowns for the additional allowance was extended by 3 months to the 30th of June 2021. And then in November 2020, the cost of new funding under the TFF was lowered to 0.1%, in line with reductions in the target cash rate and the 3-year government bond yield target. While the facility has now closed to new drawdowns, banks retain access to the funding they've drawn for up to 3 years when the final TFF borrowings mature in mid-2024. And in fact, $188 billion was drawn down. Now, most of this money has found its way into those exchange settlement accounts that we discussed above, which are now offering a tidy profit, thanks to the fact that the interest on those exchange settlement accounts just tripled from 0.25% to 0.75%. Or in other words, from last Tuesday until the loan's maturity, the banks are getting a very nice risk-free, about $1.83 billion, I calculate, straight from the RBA. Essentially, we taxpayers are supporting the banks. Now, how good is that? The biggest earner, by the way, will be the CBA, which drew down $51 billion from the term funding facility, and it stands to gain approximately a quarter of that $1.8 billion, now on offer from the RBA in the form of interest payments. If rates continue to rise, as we think they will, we could be looking at a profit of around $3 billion by July. Now, that's a lot of money risk-free to the banks, and taxpayers are carrying the burden of this ultimately. And more broadly, as the AFR reported over the weekend, the epic moves in bond yields this fiscal year have plunged the balance sheet of the Reserve Bank deep into negative equity. This is historically unprecedented territory for Martin Place and for Canberra as well, and it will need to be reckoned with ahead of the RBA's annual report, which is due out in September. The RBA said last year that negative equity would not affect the Reserve Bank's ability to operate effectively or to perform any of its policy functions, so the RBA can continue to raise rates unimpeded by its balance sheet travails. Similarly, there is not a counterparty in foreign exchange and derivative markets that will question the creditworthiness of the RBA, but that is not the end of the matter, not by a long stretch. One issue the RBA will need to address is risk management. The starting point is its Risk Management Framework, or RMF, which is a central component of its broader risk management policy. Within the RMF, there is an extensive capital provisioning regime that underpins the risks the RBA takes in financial markets, and it also informs the RBA's dividend policy in respect of paying money to Treasury. Last year, the RBA conducted its typical stress test on foreign exchange exposure, a 25% appreciation of the Australian dollar, an interest rate exposure of 200 basis points across the yield curve. And it also started provisioning for earnings at risk, reflecting payments the RBA would make on exchange settlement balances in the event of a tightening cycle, as we discussed above. Importantly, the RBA decided to no longer provision capital for its domestic interest rate exposure. The required amount was $27.4 billion. The principal justification for the change was that the RBA intended to hold the bonds until maturity, and the RBA highlighted that fluctuations in yields alter the timing of any valuation loss or gain over time, but did not change the ultimate return the bank will earn on those bonds because they're holding them to maturity. And the RBA also paid a dividend to Treasury of $2.7 billion. This reflected underlying cash earnings of $4.2 billion, in turn a function of the cash rate being near zero for most of the financial year 2000 and 2001. Now, putting this together, the RBA provisioned $15.4 billion held in the Reserve Bank Reserve Fund, the RBRF. Its total capital was $23 billion, bolstered by the Asset Revaluation Reserve on non-traded assets such as gold and property. The shortcomings of these various decisions have been brutally exposed now this year. In fact, an estimate has been made that the mark-to-market losses on the domestic interest rate portfolio is around $50 billion, and that can be derived line by line and cross-referenced, albeit with some accounting adjustments, to the statement of assets and liabilities that the RBA publishes each week. It includes bonds purchased to establish the yield curve target, as well as the program of quantitative easing. It does not include the fixed rate loans extended to banks under the term funding facility. Against this, the RBA will again post underlying cash earnings in the current fiscal year of around $8 billion. This reflects exchange settlement balances being remunerated at zero for most of the period, along with the coupon income earned and accrued. However, this dynamic is set to change. The tightening cycle will see a sharp increase in payments on exchange settlement balances, likely sufficient to shift the RBA's cash earnings negative and for many years ahead. Their negative carry that the RBA faces is particularly acute in respect of the TFF, with the main maturities not due until the third quarter of 2023 and the second quarter of 2024. At the balance sheet level, the losses the RBA is sitting on clearly exceed the provisions held in the RBRF and the broader measure of total capital. Now, while we don't expect the RBA to acknowledge this constitutes a failure of risk management, others may disagree. But in any event, the RBA will have to formally acknowledge it is in negative equity as part of its annual report. And absent a massive recapitalisation from the government, some creative accounting will be required to balance the books. The capital provision regime will also require wholesale review, not least for the forward-looking risk that the RBA still faces. And there's a second issue too, which is the fiscal cost. Now, there is some room for debate here, given that most of the RBA's domestic interest rate portfolio represents claims on federal, state and territory governments. At the fringy extremes lies modern monetary theory, which regards quantitative easing and its variance as merely an asset swap between the government and the central bank. In an Australian context, it is certainly the case that high yields have benefited the various governments against fiscal baselines. In the 2022-23 federal budget, for example, net debt fell by $58.2 billion against that reported in the mid-year economic and fiscal outlook. And high yields on Australian government securities contributed to savings of $27 billion against the forecast. But this, and the similar revision that is likely to occur in the October budget, is an accounting gain that will be eroded on the stock of AGS as the bonds pull back to par value in the years ahead. And the RBA will also benefit from this effect, but it faces a persistent drain on financing those holdings at the higher cash rate. Now, it could mitigate this by selling bonds back to the Australian Office of Financial Management, the AFM, but so far it remains resistant to this active form of quantitative tightening, and the scale would need to be very large to make a material difference. So in short, higher yields reflect a one-time gain for the government that is also facing higher borrowing costs going forward. And meanwhile, the RBA's ability to earn its way out of negative equity is being undermined by the abrupt tightening cycle that is priced, especially in respect of the TFF. This is the crux of why the fiscal cost is real. Now, last year, there was a contention that the RBA may need to be recapitalised. The key precedent remains 2013, when the then Treasurer Joe Hockey appropriated $8.8 billion at the request of the RBA. This grant, being a direct fiscal cost, was to, quote, enhance the bank's capacity to conduct its monetary policy and foreign exchange operations. Given the much more significant deterioration in its balance sheet this past year, it would seem incongruous for the RBA not to make a similar request. However, it seems that the incoming ALP government does not want to go there, given the broader pressures on the budget. So we'll have to wait and see what transpires in October. And then, of course, there's the thorny issue of the review of the RBA, something which I think is absolutely required, not least because of its pre-pandemic policies and incorrect forward guidance during COVID-19, that interest rates were not expected to rise until at least 2024. And of course, recently Lowe tried to justify that by saying, well, it was an assumption, and that was clearly communicated. I think not. But again, according to the AFR, the Treasurer, Jim Chalmers, has overridden the Reserve Bank of Australia's Governor Philip Lowe and will appoint a panel of independent experts to review the central bank, including a monetary policy expert from overseas. Dr. Lowe, who the Treasurer has said he has a mountain of respect for, has pushed for a joint RBA Treasury review of the central bank, similar to the model employed by Canada to ensure the RBA's independence from politics and to protect its reputation. And Dr. Chalmers, though, has almost finished a model for a review into the RBA, including the terms of reference and the small panel of review members, a source close to the process has now said. And he will consult Cabinet soon and speak to Dr. Lowe before announcing details of the review. Dr. Chalmers has been collaborating with Dr. Lowe about the review and has made it clear that it is not to be a witch hunt into the RBA, but the review is likely to consider the composition of the RBA board members, the 2 to 3% inflation target, and the joint statement on the conduct of monetary policy between the Treasurer and the Governor. Some observers believe the board should have more professional economists to challenge the Governor and Deputy Governor on technical monetary policy issues. The current 9-member board includes 5 business people. The 4 economists are Dr. Lowe, Deputy Governor Michelle Bullock, Ian Harper, and Treasury Secretary Stephen Kennedy. Dr. Chalmers has vowed to include monetary policy's interactions with the government's fiscal policy in the review. And it's unclear if the Reserve Bank Act will be prized open under the review. Now, some officials are concerned that any move to amend the legislation would risk the Greens in the Senate trying to add climate change and inequality to the bank's mandate. The review will be asked to report by June next year, after the government's second federal budget in May, and before Dr. Lowe's 7-year term expires in September 2023. The review will aim to deliver a substantive set of findings for the consideration of the next governor of the RBA, be it a possibly reappointed Dr. Lowe or someone new. And Sydney-based Royal Bank of Canada economist Su Ling Ong said she remains supportive of the inflation target in its current form, but there is scope for greater accountability, such as more detailed reasons for missed forecasts, open letter of explanation similar to the Bank of England, and the RBA communication has evolved in recent decades, but international best practice would suggest that there could be more which would contribute to greater transparency around the RBA's reactive function and decision-making, she said. There is much debate around the composition of the RBA board and its 6 external members that are currently almost entirely drawn from industry and historically skewed that way. Most other central bank boards are more diverse, with far greater participation by academia, public policy experts, even financial market economists, and international representation. The central bank has not faced such scrutiny since the Wallace Inquiry in 1997 stripped it of its prudential supervision of banks. Besides a fully independent review by outsiders, another option canvassed by Treasurer and the RBA was an outside panel of experts, along with a joint RBA Treasury review. However, a group of senior economists wrote to Dr. Chalmers last month calling for an independent review by outsiders, including the involvement of a foreign expert. The group of 11 economists included former RBA board member Warwick McKibben, Saul Estlake, Chris Richardson, Peter Tulip, Danielle Wood, Richard Holden, and Stephen Hamilton, who said the review was a once-in-a-generation opportunity and must not simply be a performance appraisal. No institution can be expected to independently or critically review itself, they said in the open letter. A foreign perspective would bring valuable external scrutiny to the process and enable a benchmarking of the RBA against its overseas counterparts. The RBA is already conducting an internal review of its extraordinary pandemic-era policies, such as the 0.1% cash rate, the $350 billion in government bond buying, and the $188 billion in cheap loans to commercial banks. And on Tuesday, it's going to release a review of its 0.1% 3-year yield target, which was forced to abandon last year after the market bet heavily against the RBA's word. Last September, the Organisation for Economic Cooperation and Development said the RBA's overly tight monetary policy before slashing rates during the pandemic had contributed to undershooting the 2 to 3% inflation target before COVID-19. And in fact, the OECD recommended that the RBA's monetary policy and government's budget frameworks be reviewed. Legacies of the pandemic, in the form of higher public debt and limited monetary policy space, will present challenges for macroeconomic management going forward, the OECD said. And Dr. Chalmers said in May that he had a mountain of respect for Dr. Lowe and wanted to ensure the RBA remained independent. This is a really important opportunity to examine the framework, the operations of the Reserve Bank, to make sure that we are making monetary policy in this country in the best possible way and considering the interaction with fiscal policy as well, he said at the time. Now, this is a very important discussion, and it is very, very critical that we have the right lens on any review. We're already seeing the RBA trying to backpedal and try and explain why it did what it did, despite the fact that, of course, that many people would feel misled by what they said. But the real question I've got is whether the review is going to be deep enough and far enough, or whether it's effectively going to be a self-perpetuating machine here and effectively make some minor tweaks but nothing major. The fact is, the RBA has done us no service at all in recent times. It consistently misses its targets, and frankly, the fact that it's managing to pay loads of our money across to banks who really don't need it is another factor that should be thought about too. And as for that negative equity problem, well, that's definitely going to have to be covered up in some way, or at least exposed later in the year. So we do have some very big questions for the RBA, and I still am not sure whether in fact the RBA will have to turn turtle later and start cutting rates again due to the damage being done to the broader economy. As I discussed with John Adams previously, they are caught between trying to tame inflation on one hand and trying to avoid financial instability on the other. This is a self-made problem with them, of course, and APRA, and maybe even ASIC as well. And perhaps if a review of those were included, we might be getting somewhere, but I don't hold my breath on that one. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.